Hi, I'm a management accountant. I'd like to discuss a little bit about the reasons why businesses nowadays are always so short on cash. Firstly, customers on credit terms are generally paying too slowly, and by that I mean both in terms of the agreed payment date being after the date when the suppliers are expected to be paid, and also just in terms of just failing to pay their invoices on time. Now, naturally, you've got to pay your suppliers, your staff, your taxes, your other overheads, and if that happens before the customer even pays you, that's going to compress your cash flow, and it makes it difficult to continue operating effectively and fulfilling other orders whilst you're paying for orders that haven't yet been compensated by the client. Therefore, I'd advise you to think about negotiating better payment terms with the suppliers, maybe asking for more time to pay, asking to pay in installments if needs be, negotiating shorter payment terms with the clients. Maybe that is pro forma payments, so getting paid for the work before you commence, or taking a deposit, or at least taking the cost of the materials or whatever supplies you are needing to pay for that piece of work before you commence work on that client's project. Effectively chasing late payments. So a lot of business owners, they kind of just leave the debt chasing until they're short of money, or until they get to a reporting date or something like that. You need to be on it all the time. I'd recommend, if you can't do it every day, at least do it once a week. Ring people up, email them, message them, whatever you need to do to remind them that that bill needs paying. Because obviously every day that money's not in the bank, it's compressing your cash flow even more. And then if needs be, try and avoid going to high cost lending. There's a lot of businesses that will offer essentially payday loans to businesses, and that can be quite detrimental to the long-term survivability of a business. If you can, try and get an overdraft facility, or invest a little bit more money into the business, or see if you can get lending from a normal bank rather than these short-term business loans. Secondly, often profit margins are way too low, and this is not necessarily an issue with sales volumes. It could be that the sales volumes are great, but the amount that you're charging for each piece of work is too low, or the costs of carrying out that piece of work are too high. Now, where I tend to see this originate from is businesses that try and offer a premium quality service or a premium quality product for rock bottom prices, and by doing that they're trying to compete on both quality and on price. I would advise that you pick one or the other, not both, because if you compete on both, you'll either end up having to operate on a razor thin margin, which leaves you with absolutely no overhead in the account to pay unexpected expenses, other bits and pieces that might crop up, which can then mean that you might struggle to make payroll, or you might struggle to make payment of your HMRC liabilities, and then therefore you might struggle to retain the high quality staff that you've got that allow you to provide that premium quality service for that price. So therefore it's better to focus on either competing on quality and therefore charging an appropriate price for that quality, or if you want to offer bottom prices, make sure that the quality is not necessarily bad, but it's just acceptable. It's like the low-cost airlines trying to compete with the big boys on the transatlantic routes. No low-cost airline has ever managed to make a transatlantic route work, because the economics just don't line up, and that's the same at every level of business. 3, you're trying to grow too quickly, or trying to grow before the business is really ready for it. So if you build capacity in the business before the demand is there, obviously this is operationally great because it means that you're never going to have a period of time where staff are overworked or having to put in overtime. But having idle staff and idle hands and idle machinery presents what can be a fatal inefficiency. If you've got assets or staff sat around twiddling their thumbs they're not generating money for the business, and obviously you've got cash then tied up in those things that can't be used to pay the bills. But similarly, if you wait until you're well over capacity to meet the demands, then you're going to have to compromise on quality and reputation. So if say for example you suddenly get a rush of orders coming, and you haven't got the staff to man that, the staff are going to cut corners and they're going to work long hours, which means that more mistakes are going to be made. So obviously you need to be able to plan the growth and the expansion of your asset pool and of your staff and any other bits and pieces of your business that you might need to grow in accordance with where expected demand is going to be, and you need to make sure that it's timely. That's where analysis on your business's past and expected performance will give you vital insights to decide on when the correct time to do that expansion will be. Similarly to that, having too much cash tied up in assets or stock. So if you've got stock sat on your shelves, computers sat around that are unused, vacant office space that you're paying for but isn't being used for anything meaningful, that's all holding cash which you can use to pay your bills. If this situation sounds familiar, take a look at your company's assets and think, is there a way we can release cash from this asset without damaging future benefits? So for example, you might want to rent out any unused office space. You might think about selling or leasing unused equipment. You might think about implementing inventory management procedures that mean that you've got better predictive methods for deciding when your stock needs to come in and in what quantities, rather than having stock sat around on the shelves for a long period of time going unsold or unused. Finally, the biggest thing really is not looking after the books properly and not forecasting the cash flow. Without a cash flow forecast, it's very, very difficult to see when upcoming cash shortages are going to take place, and it will often take you by surprise. Regular forecasting helps you see when money is expected to be in, what needs to be paid, and when action may be required. The biggest reason why small businesses struggle with this is often they operate the books on a cash accounting basis. This means that they record income and expenses only when they actually go through the bank account. Because of this, you can't easily see within the books what's due in, when it's due in, and what's due out and when it's due out. You're essentially treating each day as it comes, and not only can this be dangerous from a cash flow perspective, it can also cause problems with the computation of your tax, which will then potentially lead to higher tax bills than are strictly necessary, which is then going to compress your cash flow even further. So I'd recommend that anyone who operates on a cash accounting policy considers whether it might be better to proactively record the transactions when they're first realised, rather than off the cuff when they impact the bank later. Doing so would give you a greater accuracy in your figures, stability and control. So the key lesson here really is that profit and sales don't always equal cash, and understanding where the money is going helps you to understand and make better decisions before a cash flow problem can evolve into a cash flow crisis. And obviously a crisis can lead to liquidation and the failure of the business.